This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performances do not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk. There's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading.
Good afternoon, traders. I'm Scott Norris, wrapping up the week with your Forex report. Today is Friday, February 16, 2007. Well, it was a tough week for the U.S. dollar as a string of dismal economic reports sent the currency lower in the broad market. Intraday volatility remains high, and the theme of moving contrary to the news also persists. It seems as though weak data leads to initial strength in the underlying currency, and vice versa. For this reason, we have not been trading news releases for several weeks. Some of this week's biggest surprises in U.S. data included tick data dropping to a mere 15 billion in December, and January housing starts falling to a 10-year low. And it doesn't stop there. Everything from retail sales and the trade balance to jobless claims and industrial production came in much worse than forecast. We really can't see how dollar bulls are left with any soapbox to stand on. One of the highlights this week was the Humphrey Hawkins testimony delivered by Fed Chairman Ben Bernanke on Wednesday and Thursday. In his address to Congress and the House of Representatives, Bernanke indicated that inflation may be slowing toward a more tolerable level. However, he also reiterated the lack of spillover from the slowdown in housing into the rest of the economy. As it pertains to the dollar, the two-day event may not have really changed traders' outlooks all that much. The buck still looks very vulnerable to further declines early next week. Of course, we are also at or near very strong support levels for the currency in most pairs, which could limit losses ahead of fresh data. Now to the big picture. We discussed the G7 meeting and the unwinding of carry trades in last week's big picture, and we'll follow up today. Traders who were selling the yen ahead of the weekend's big event were correct in their expectations that the yen would not be mentioned in the communique. The Japanese currency slid even lower at this week's open upon the release of the G7 statement, but the decline was short-lived. Traders soon began to liquidate carry trades, and the floodgates opened when Japan released its latest GDP data this week. While traders did not find any statement to translate into a green light to sell the buck, as we saw last April, the U.S. currency has been struggling since the meeting. Housing is still one of the biggest risks we see to the U.S. economy, and the jury is still out on whether the worst has come and gone. Subprime mortgage default rates are looking scary every week. We believe the signs that housing has already bottomed out are a bit too optimistic and still see the potential for spillover into other areas of the economy. This could become an increasingly heavy weight for the U.S. dollar in the weeks and months ahead. Till next week, I hope you all have a wonderful weekend. Take care.